Hi there, welcome to Kneppy Invest. I wasn't going to do a video on Damstra because the share price has been in a well-defined downtrend for about a year and just keeps on going down. However, when they released the half-year report, there was another downgrade in there and the market has punished the company, share price down 20%, and since October 2020, when Motley Fool Extreme Opportunities recommended this company to their paid members, the share price is down 92%. The question is, when is the bleeding going to stop for this company and its shareholders? To be honest with you, it is actually looking quite attractive when you take into account the valuation. The annual recurring revenue is growing at a fairly small rate, and I do think there is potential the market is overreacting right now. There's also the potential the market has got this completely right, and there are dark times ahead, possibly for Damstra. What does Damstra do? Well, they have Enterprise Protection Platform, EPP, that really aims to protect the businesses for most important or maybe largest investments, which is people, places, assets, and information. So they want to prepare people, make places safe, connect assets, and make information accessible. And the whole aim is to protect organizations from unnecessary and unforeseen business risks. And these are some of their products they do have for their clients or customers: workplace management, track time and attendance and ensure all workers are compliant at all times, access control, verify workers via swipe card, fingerprint, or facial recognition, asset management, accurately track and maintain assets on site to ensure they are compliant as per client regulations and specifications, Damstra safety, manage risk, compliance, and safety intelligence. So they have a lot of products, a lot of things going on, but unfortunately at this point in time, the company has experienced some troubles over the past, we'll say 18 months. And one of those problems for Damstra was they lost a fairly large client. If I could be completely mistaken here, but for some reason I'm thinking American Airlines, and that could be some truth to that, because when you look at the distribution of their revenue geographically, they did see a significant drop in revenue in the United States. Anyway, Damstra was founded in 1998. Pretty sure it was a father and son team with a last name called Damstra, listed on the ASX 16th October 2019. So it hasn't been around that long on the ASX, so about 2.5 years. The CEO and founder is Christian Damstra. He has a 9.7% holding in the company. One of the other major shareholders is the chairman, Johan Zrisau. Hopefully I at least get fairly close to the pronunciation of his last name. He has a 9.8% holding. And the market cap, the valuation of this company right now at 19.5 cents, which was a share price at closing on the 1st of March, was $50 million. Now, in saying that, they did release details of a new contract, and the share price has popped up another 10%. So it has risen from that 19.5 to something like 21 cents, but that could be just a short-term pop. I'm not the biggest fan of buying into a company off just one contract or one piece of contract news. I like to see that flow on into other contracts down the line. And the ticker code for Damstra is DTC. Now onto some financial news, financial data for the company. And we're going to look at the operating cash flow, or the Appendix 4Cs, for 2 quarters, 1 year apart. So going back to the December quarter last year, and then we'll look at the most recent December quarter, and then we'll have a look at some of the half-yearly stuff and why the market did punish Damstra and its share price. So let's go back 1 year to the December quarter of financial year 21. So this is 2020, and receipts and customers to 7.4 million. They were operational cash flow positive by 273,000, but they did receive government grants and tax incentives, which turned the company from being operational cash flow negative to positive. The other thing you've got to take into account here is they do spend a fair bit of money on capital expenditure, property, plant, and equipment, but especially intellectual property. and in this particular quarter they spent $1.3 million. So even though they're operational cash flow negative, they spent about $2 million on financial and investing activities, which meant the cash on hand in the business actually dropped $2 million from $9.6 million to $7.6 million. So now if we have a look at the most recent Appendix 4C, we'll see that receipts actually have gone backwards over the past year, and we're right on $7 million. Can't get any more perfect than that. But even though receipts have fallen, some of the costs have remained about stable or steady. So they have become operational cash flow negative by $323,000, even though they did receive a little bit of government grants and tax incentives. They did do a major capital raising, $20 million capital raising. So the cash on hand actually increased from 6.7 to 18.7. And their spending on intellectual property has actually increased. And now they spent $2.2 million in this particular quarter. And this is a quarter per quarter expense. So it's just not a one-off expense. It actually happens every single quarter. So if you take all this into account, the balance sheet looks a little bit better just because they do have $18.7 million of cash because of that capital raising. But they are, if you take away that capital raising, they are still burning cash quarter on quarter. Now let's have a look at the half-yearly results. So now revenue is increased from 12.1 million to 13.2 million. That is a tick. I'd like to see revenue increasing, albeit slowly. Gross margins did go backwards slightly from 75% to 73%. I would prefer to see gross margins rise. And they have become operational cash flow negative on a half-yearly basis. So 1 year ago, they're actually positive by 2.6 million. Now they're negative by 2.1. We're going to sort of ignore, or we will ignore profit because they were unprofitable this particular quarter by $56 million. More than likely, and haven't really looked at this, more than likely that was just a write-off in something. And last year they were actually loss-making by 5.4 million. Net cash, 8 million. They do have a little bit of debt. And something to focus on here, annual recurring revenue have increased over the past year from 24.2 million to 27.8 million. So a lot of annual recurring revenue. And when you calculate, one of the valuation metrics I do have for these type of companies, these SaaS companies, EV annual recurring revenue, it's only 1.5, which is significantly lower than what you usually see for these type of companies. So at this point in time, the market is paying a discount for this company just because of the massive amount of negative sentiment around Damstra. Probably doesn't hurt or help that the company has released 2 downgrades over the past 4 months, which I'll touch upon towards the end of this video. And even though annual recurring revenue is growing, if you compare last year to this year, we're not really seeing that growth in receipts history just yet. It is growing if you take the end point and the start point in isolation. It's grown from 4.6 million to 7.0 million. But over the last 6 quarters, receipts have gone sideways. There was one really good quarter in there, the June quarter of 2021, and you'll see the market response to that particular quarter. The share price did take off for a short period of time. It looked like it was breaking out, but that was a false breakout because the receipts have dropped off over the last 2 quarters. So receipts history doesn't look the best right now. So if we just focus on the recurring revenue growth, it looks pretty good, but that's not being reflected in receipts growth just yet. One of the things that did concern me when I read through Damstra's half-year report was an increase in some of the company's costs. And the company went through this in their presentation, and some of their commentary did sort of wane away my concerns slightly. So they provided this particular table in their presentation, and they went through the revenue, which has increased from 10.1 million to 13.2 million over the past 2 years. Gross profit has increased from 7.1 to 9.7 million over the same period of time. But there has been a significant increase in 2 of their costs. That is sales and marketing, which has more than tripled from 1.3 million to 4.6 million. And general and administration costs have more than doubled from 1.9 to 4.2. Because of that blow up in cost, the company has gone from being pro forma EBITDA positive by 2.6 million to being negative $200,000. And they did mention in their commentary that there is a cost reduction program underway, and they are saving about $1 million of cost reductions. Well, they have identified $1 million of cost reduction. So looks like they are aware of this. The very fact they've provided a table about this, and they're aware of this blow up in costs in the recent 2 years, and they're trying to fix that. So if they can continue to grow revenue, gross profit over the next few years, and maintain a control on costs, we might see this company becoming profitable again in the future. Two things I really like to see in regards to a company's results or their performance is just a geographical breakdown, also a product breakdown as well. And in note 3 and note 4 of the half-year report, you'll find this information in regards to Damstra. So by far, the majority of this company's business is in Australia, and they are growing in Australia as well. In fact, revenue in Australia grew from $9.3 million to almost $12 million in the past year. New Zealand revenue grew from $343,000 to $472,000. Unfortunately, international performance has cratered. It has absolutely fallen off a cliff. More than likely, it's because of that major loss of a client, but international operations revenue has fallen from 2.4 million to 774,000. They also mentioned here the significant portion of revenue from the group's international operations was earned in the United States. So if they didn't have that international operations, if they didn't lose that major client, this company would have performed fairly well over the past year. And if we back it down into the major product lines, this is in note 4. Software services increased from 7.9 million to 10.2. Rental of hardware equipment actually fell from 2.8 to 2 million, and implementation other support services fell from 1.5 to 926. Now, also would have liked to see some margins in regards to these major product lines. Does the software service have significantly higher margins than the other two? I'd probably say yes. And this is a good thing that we've seen an increase in software services if that software service has higher margins than the other two, rental of hardware equipment and implementation of other support services. Now to downgrades, and the market absolutely hates downgrades, and whatever a company's management does, the worst thing they can do is provide the market a downgrade. 2 downgrades is even worse, 3 downgrades is the worst, and 4 downgrades is, well, something that happens very rarely, but a company has done that recently, and that's A2 milk. You don't want to issue any sort of downgrades because that means the company is performing worse than you expected, and that's bad news. Anyway, the most recent downgrade, other than the downgrade they released in the half-year report, was only 4 months ago in their AGM towards the end of November, and this was in regards to revenue and EBITDA margins. Revenue has dropped, or expected revenue has dropped by about $5 million, and EBITDA margins has dropped from between 22.5% and 25% to 15% and 20%. The market didn't like this, share price dropped, and that's exactly what you do expect whenever there is a profit downgrade. And yet the company released another downgrade in their half-year report. Now this downgrade, and I should mention that all these downgrades are for financial year 22, so we're already more than halfway through this financial year. Now this downgrade was not in regards to revenue. They still expect revenue to be between 30 and 34 million. However, there was a significant downgrade in the EBITDA margin, falling from between 15 and 20% to now between 2 and 5%. They mentioned why. It was due to the performance, a half-year performance, and the rebasing of their business. And they are assuming that there is no material change in market conditions. The worst thing a company can do is to make assumptions. We saw that with A2 Milk, and they did pay the price when they started assuming stuff. So hopefully this is the end of the downgrade cycle for Damstra, because if they release any more downgrades, I think this negative sentiment in the company will continue for a while yet. Upon the release of the AGM downgrade, late November 2021, this was a chart. And the price at that point in time was 44 cents and had reached a fairly good support level at that point, because that was low we saw during the COVID-19 financial panic. You can just see here the share price rise from the global COVID-19 financial panic to the share price high in October of the same year. In fact, the share price rose from 44 cents to a high of $2.44 during March to April. So that's a 7-month period where we saw the share price increase something like 6-fold. But ever since that high, in October last year, exactly around the time that Motley Fool Extreme Opportunities recommended this company to their members, their paying members, the share price has continued to fall and fall. The only time we saw a potential breakout was in July last year when they released that quarter with $10 million of receipts. So we did see a share price rise from about 75 cents to $1.20 in about 3 trading days because of that particular Appendix 4C. It was short lasting, that breakout failed, and we have seen the share price continually fall from there. So at the AGM, the share price was right on a support level. Did we go through that support level on strength? That would be a fairly bearish move. Well, let's have a look at the most updated chart. And this is the most updated chart for Damstra, not including trading on March the 2nd, and I'll talk about that in a second, but this is from the high in October 2020 to March the 1st. The share price has continued to fall, and that support level at 44 cents fell through that on fairly good strength, high volume, and has continued to fall there. So that's no longer support. You might say that is now resistance, and the share price now is probably at an all-time low. Well, it was at an all-time low at 19.5 cents. But so much negative news, so much negative sentiment around this company. But fortunately, for long-suffering shareholders, the company did release some good news on March the 2nd. Now, to the good news shareholders and the company has been waiting for. Now, I'm a little bit wary when a company does release an announcement in regards to one single contract. I think this company needs to roll out or announce a few more contracts before we can confirm that this downtrend has come to a completion. But this contract or this partnership is regards to the Northeast Link project in Victoria with Spark Consortium, and it's expected to provide Damstra with about $5 million of revenue over 6-year life of the project. The market has responded positively. Share price up 12.8% about 1 hour after trading has begun, and right now is at 22 cents. Is this the turnaround in sentiment and the trend in Damstra's share price? Who knows? We're going to have to wait a little bit more. We'll have to see if this little bit of hype, excitement in the company wanes away over the next few trading days. That is all I have for this update to Damstra. Share price down 92% since October 2020. I hope you did not buy into Damstra based off the recommendation from Motley Fool Extreme Opportunities. I know a lot of people did, and I still don't understand why people blindly follow those sort of recommendations. Only you can make that sort of recommendation in regards to a company, whether that company fits into your portfolio or your investing strategy. So my own advice to you is make your own decisions. Don't let other people make investing decisions for you. And even though I am saying that, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.